Hello, I'm Hickey from interest.co.nz, and welcome to another in our series of double-shot interviews. We bring in someone interesting who's got something interesting to say. And today we have Brian Gaynor, who is the head of Milford Asset Management, which manages quite a bit of KiwiSaver funds and is also a manager of funds for the New Zealand Superannuation Fund.
That's right, yes.
And busy time in the next few months, particularly next year, with a lot of these state-owned enterprises potentially put onto the market to be sold. What's your view on whether there's enough money in New Zealand to buy these companies as they're listed?
I think it's going to be very difficult to get the three or four of them off the ranks unless things do improve quite dramatically. I think there's demand for one, possibly demand for a second one, but it's going to be very difficult to get three electricity companies plus Solid Energy plus a sell down of Air New Zealand, particularly in the space of 1 or 2 years. It will take a lot longer than that, I would imagine, unless market conditions improve quite dramatically from where they are at the moment.
The ones that seem to be first off the block are the big power companies, Mighty River and Genesis. How attractive are they from a fund manager point of view?
They are attractive. I mean, you've got to be very careful, though. You can't be overexposed to the electricity industry because it is subject to variabilities like the weather and regulation that you've always got to be careful of. But I think that there's a reasonable scope, particularly for KiwiSaver and superannuation funds, because we look at them as reasonably stable, long-term companies. I mean, they're not like an airline company that can go into receivership and go bust. They are long-term assets, and that tends to match the duration and the interest of the investors in KiwiSaver funds and superannuation funds. So you will get a reasonable amount of interest from KiwiSaver funds and other superannuation funds.
Now, of course, we haven't seen the prospectuses or any of the details of these companies once they're listed. But when people see them or hear about them, what sort of things should they look at in terms of, is this a good deal or not?
Well, I think the first thing they should register with their broker or brokers and make sure their names are down, because we had situations with TradeMe where people left it to the last minute or they hadn't registered with brokers. It doesn't mean that you have to participate in the IPO, but at least your name is on the list. Then, of course, when the prospectus comes out, you do have to look at a prospectus. The first thing probably to do is to compare the valuation of the company with Contact Energy and Trustpower, which are two generation companies. And if it looks cheap relative to them, that's a good starting point. If, however, the new IPOs look more expensive than the existing listed companies, you have to be a little bit more careful. So we're lucky to an extent that we've got two electricity generators already listed, and we can compare the valuations of the new IPOs with them.
Now, we've got a lot of turmoil in the global economy at the moment and in Europe. Should people wait for that to be settled before they think about getting into the stocks like this?
Not really. I take the view that actually these markets create opportunities. You know, I think that there's been a tendency in New Zealand that people only invest in the good times, and of course that means when share prices are high. So it is, particularly for companies like electricity companies, because they shouldn't be that much impacted what's happening in Europe. They're not exporters. They're not like an airline company that can depend on tourism flows or business flows, etc. So I think it's actually a good time to look at electricity generators, particularly as it's going to mean that they're probably going to be listed or floated at relatively low prices, as we at least that we hope. So this kind of environment creates the biggest opportunities. In fact, if you look through history, often the more wealthy people have been the people that have invested during bad times and taken advantage of low prices. So I wouldn't say to people stay away because of the turmoil. I would say keep an interest in them and look and see what the pricing is.
The other big thing hitting the market at the moment is TradeMe, which is due to list on the stock exchange next week. There's been a marketing process, the prospectus is out, you've had a look at that. What's your view on how attractive otherwise TradeMe is?
Well, first of all, we take a long-term view, so it's not a matter of whether the shares are going to come on at $2.70 or $2.80 or $3 next week. We think that we didn't get as many shares as we wanted to in TradeMe, and most institutions were in a very similar situation. They got probably less than half of what they were interested in, so that is indicative that the interest out there is reasonably strong. We look at it's got a very good brand name in New Zealand. It's got the ability to add on the kind of services that it has. We're impressed with the management team. Now, that doesn't mean we think it's the share price is going to go sky high when it lists, but we do think that it's a good company to have. We're delighted that it's listed on the share market, and we think if it's managed and run properly, it will deliver good returns to investors over the next few years.
Is there a risk, though, that it's a mature market, it dominates the sector, maybe can't grow as fast as it has in the past?
Yeah, that could be true. But see, I like to compare it with Sky TV network, which is in a similar position. It only operates in New Zealand. A lot of arguments when it came on that it was up against TVNZ, and TV3 came along, and it was a fairly mature market, and that it already had the market as it was. But in actual fact, that company has added on extra items, extra channels, extra things. So the addition of the extra channels has meant that it's been able to charge a bit more and attract new customers. I see Trade Me a bit the same way. It's going to be able to add on different things that it can trade through me. And I don't know whether you saw, it's quite interesting that eBay in the UK have started opening retail stores on High Street. Now, I'm not suggesting that Trade Me is going to get into the retail business, but once you've established a very strong brand name, you do have the capabilities of doing things that often the investors don't perceive that can be done when a company is listed.
Yes, well, thank you very much, Brian.
Thank you.
We're entering into a new era, really, for New Zealand, with a lot more companies on the market, a lot more interest. That was another of our double shot interviews. I'm Bernard Hickey for interest.co.nz. We've been speaking to Brian Gaynor from Milford Asset Management.